Hello, good day. My name is Akira Yamanaka, and I will be discussing the research entitled Portfolio Selection Using Mean Variance Theory based on the 30-year historical returns of selected subsectors of the Philippine industrial sector. Introduction. There are a total of 283 listed companies in the Philippine Stock Exchange, or PSE, as of 2020. The PSE is divided into eight sectors, namely financials, industrial holding firms, property, services, mining and oil, small, medium, and emerging board, and exchange traded funds. For this study, the industrial sector was explored. This sector is responsible for 29.23% of the Philippines' GDP last 2022. The industrial sector includes companies that are involved in manufacturing machinery, equipment, tools, and other industrial products. This study will utilize the Markowitz mean variance theory, or MVT. MVT states that logical investors fear risk, and when presented with options with comparable risks and rewards, will most likely choose the investment with the lowest possible risk and the highest potential return. The basic portfolio selection framework is comprised of three components, were also explored in previous research works. Some research showed that an optimal portfolio delivers the highest possible return with least risk by selecting a balance between stocks. Another study indicated that on various products, equities with lower behavioral ratings beat portfolios with higher behavioral ratings. Um, The return estimation is forecasting the possible future returns of an asset in the investment. Assignment of weights can be defined as the delegation of likelihood or probability that represents the judgment of an investor. Return estimates and assignment of weights will serve as the foundation of the selection of the best portfolio model for an investor. Each simulated portfolio with a corresponding risk return trade off coefficient, denoted as alpha, will be compared to one another with the market as the benchmark. The study will utilize the 30-year historical returns of the Philippine Stock Exchange from 1993 to 2022. The goal of this study is to use the mean variance theory to determine which risk return trade off coefficient of selected subsectors of the industrial sector can outperform the industrial sector as a whole and the market, as well as giving off recommendations on which companies um, prospective investors can invest on. Methodology. So, the investment pool consists of three subsectors of the industrial sector, as shown in the right table. Chemicals with six companies, other industrials with three companies, and electrical components and equipment with seven companies, for a total of 16 companies. In selecting the optimal portfolio, this study utilizes the mean balance portfolio, as mentioned before, in choosing the best risk return trade-off coefficient. This study used 7,670 return scenarios that are generated for each test period. Mean variance investors have different risk return trade-off coefficients. Thus, 10 sets of alpha are used to consider the behavior of investors. Values near zero are for conservatives, while values approaching one are for risk-driven investors. The basic statistics of the actual return shall be compared. One sample t-test is used to compare the portfolio performance. The outliers are removed before simulating t-tests. So, results. For the data description, the data collected spans 30 years, beginning 1993 and ending in 2022, which corresponds to 7,670 trading days. The backtest period was conducted from April 11, 2024 to April 17, 2024. This study has a total of 41 portfolios, 10 for each subsector, equivalent to 30 portfolios. Since there are three sectors that were considered, and one for the market, which is the benchmark of the study. Some sector portfolios are denoted as MV. while risk return trade-off coefficient is defined as alpha from zero point 0.1 all the way to 1.0. So here is the portfolio designation. Note that as the value of alpha increases, the portfolio becomes riskier. So, for example, we have zero point 0.1, we have 90% concern on the risk, while only 10% for the return concern. But as we go higher, for example, 1.0, well, the concern on risk is almost inexistent, while the concern on return shifts to nearly 100%. So here is the backtest results for chemicals. So the return statistics for the chemicals subsectors are shown in a table on the right side. So values for zero point 0.6, 0.8, 0.9, and 1.0 for the alpha showed higher values for the mean return. In terms of standard deviation, alpha equivalent to zero point 0.1, 0.2, and zero point 0.3 showed lower values compared to the market. However, there are no alpha showed higher values for the cumulative return compared to the market. The p-value of the MB portfolio compared to the industrial sector showed that zero point 0.4, 0.5, zero point 0.8, zero point 0.9, and 1.0 showed significance for p-values less than 0.01 at 99% confidence interval. The same observation cannot be said, however, for the p-value versus the market, wherein no values of alpha were found to be significant. So here is the cumulative returns of the MB portfolio for the chemicals sector. Unfortunately, no alpha showed higher values for the cumulative return compared to the market. Here is the backtest results for the other industrials. So return statistics are shown in the right table. Results show that no alpha showed a higher value for the mean return and cumulative return. In terms of the standard deviation, alphas of zero point 0.1, zero point 0.2, zero point 0.3, zero point 0.4, and zero point 0.5 showed a lower value compared to the market. For the p-value of the MB portfolio versus the industrial sector, showed that values of alpha at zero point 0.4, zero point 0.5, zero point 0.6, 0.8, and zero point 0.9 were significant with p-values less than 0.01 at 99% confidence interval. Zero point 0.3 and zero point 0.7 with p-value less than zero point 0.1 at 90% confidence interval. So p-values versus the market showed no significance in any confidence interval. So here is the cumulative returns of the other industrial subsector, which show that no alpha showed a higher value for the mean return and cumulative return. So lastly, for the backtest results for the electrical components and equipment, the values of zero point 0.2, zero point 0.3, zero point 0.4, and zero point 0.5 showed a higher value for the mean return. With regard to the standard deviation, zero point 0.1, zero point 0.2, zero point 0.3 displayed lower values for this parameter. The values for the p-value versus the industrial sector is significant only at zero point 0.4. Just like the previous subsectors, the p-value versus the market shows no significance. So here is the cumulative returns for the electrical components and equipment subsector, wherein results show that cumulative returns are higher versus the market for alpha at 0.2, 0.3, and zero point 0.4. So discussion. The goal of this study is to use the mean pairs to determine which risk return period of coefficient of selected subsectors of the industrial sector can outperform the industrial sector as a whole in the market. For chemicals, the best option is to have an alpha equivalent 0.2. Results in this risk return trade-off coefficient denotes 0.0001 for the mean return, 0.0062 for the standard deviation, and 1.1540 for the cumulative return. This is the only variation in this subsector wherein the returns are not less than 1. For the other industrial subsector, the best option is to have an alpha with a value of zero point 0.1. Mean return accounts for 0.0000. Standard deviation is lower 0.0000, and cumulative returns is 0.0000 as well. It can be deduced that the parameters in this alpha denote a break-even when an investor decides to invest with respect to this alpha, which is safer compared to the other alphas that gave off adverse results. For electrical components and equipment, the best alpha is zero point 0.2, which is 0.003, which is at par with the market, 0.0099 for the standard deviation, and 6.7878 for the cumulative return, nearly double that of the market. The composition of each recommended portfolio and the corresponding allocations for every subsector where insignificant gains are possible are provided. The allocations are obtained by getting the average of the days where actual trading occurred. Actual trading days are determined when values are present in the budget return cells. Total percentage of the allocations per subsector should be equal to 100%. So here is discussion. The portfolio allocations are provided on the right side of this slide, wherein certain allocations for each subsector are provided based on the results obtained from the study. For chemicals, we have zero point 0.2 alpha, LMG with 53.1328%, and Euro with 46.8672%. For other industrials, alpha is zero point 0.1 with two companies, namely TCP with 57.1429% and STN with 42.8571%. For electrical components and equipment, at zero point 0.2 alpha, we have four companies, namely CIC with 30.5732%, Green with 29.771%, Tech with 20.9395%, and ION with 18.7102%. So this dual focus on return and risk allows investors to create portfolios that might maximize return for a given amount of risk or conversely limit risk for a given predicted return. As such, a diversified portfolio could reduce risk without necessarily sacrificing returns. This framework is also beneficial to financial managers in aiding them in allocating resources more effectively across different assets. Moreover, these managers can construct portfolios that align with an investor's risk tolerance, ensuring a balance between expected returns and their risk exposure. Conclusion. So, this study presents a simple variation of the mean variance theory. For the investment pool, 16 companies that are part of the selected subsectors of the industrial sector were considered. For, for portfolio evaluation, the benchmarks the industrial sector and the market are used. Um, After selecting the investment pool, the return estimates are done using backtesting, wherein 7,670 scenarios were generated, representing the trading days in the 30-year historical data from 1993 to 2022. Results showed that MB portfolios can outperform the industrial sector, and, however, not the market. While p-values versus the industrial sector are mainly significant, p-values versus the market show no significance. This finding represents a need for more data on how selected subsectors can outperform the market as a system. Additionally, investors must be cautious when deciding to invest in these three subsectors, considering the values obtained from the simulation. Despite its foundational role in portfolio optimization, mean variance theory has some multiple limitations, one of which is it relies on previous data to predict future returns, risks, and correlations. A wide range of factors, including geopolitical events, financial trends, and investor attitude all have an impact on financial markets that historical data cannot reflect. This reliance on past average might lead to erroneous estimates, sometimes leading to inefficient portfolio structure. So, acknowledgement. The authors express their utmost appreciation to the whole university, which should serve as an avenue for making this research possible. That would be all. Thank you for listening.